Hi everyone, welcome to Chapter 10. Chapter 10 is all about property, plant, and equipment. It's many things about property, plant, and equipment, probably too many. There's a lot of little subtopics, but the two main areas and what my YouTube number 2 and 3 are on are those two main areas, which are the depreciation methods in video 2. I'm going to go over them a little bit in the highlights as well. And then in video 3, it's selling plant assets and showing if you have a gain or a loss. That's the other big part of the chapter. Those are the two kind of main sections, and then there are a lot of little subtopics, I call them. So I'm going to go through everything kind of briefly, just to kind of give you the feel of it, and then you can check out the other two with the examples. They are lab problems, and they're pretty comprehensive. They have a lot of different concepts of the chapter in the labs. So I think you'll find them useful. So the chapter starts basically on page 538, and it talks about how we measure the cost of property, plant, and equipment. And if you think back to 101, when we separated current assets from the longer term assets, we called those longer term assets plant assets or property, plant, and equipment. And even when we introduced those in chapter 3, they showed us straight line depreciation, which is the most popular depreciation method. They showed us one example of it, how to do it. It's a very easy formula. But then from then on, they just told us what it was. And all we had to do was debit depreciation expense and credit the accumulated depreciation account that went with that asset. All plant assets depreciate except land, if you will recall. So it's going to be the same thing here, except now we have to figure out the depreciation, okay? And it's not difficult. It's just, it depends which method you use. So the first kind of 539 to 544, and if you're looking at your slides, it's slide 10-5 through 10-7. Kind of shows you how to measure the cost of assets, and also at the bottom of 539, it shows you the life cycle of the plant asset, the acquisition, which is the purchase, the depreciation, the life of the asset, and how we debit the depreciation expense, credit the accumulated depreciation account. And it was a big deal at that time to never credit the asset. And I always emphasize that, and I did even in our online class this summer, and whenever I have an in-person class. In this chapter, it's for the first time when the asset is physically gone when we sell it or we just discard it. The other thing you can do with a plant asset is trade it in for a new one. That's probably the most popular thing. We trade in our cars for a new car. And that's probably number one in what businesses do also. But we're not responsible for doing that in this chapter. It is in the appendix, which means we don't have to be responsible for it at this juncture. But it's really the same thing. The only additional thing you have to do when you trade it in is put in the new one, debit the new asset, and also if you put any money down, you would credit cash, and if you took out a loan to pay for it, you would credit your notes payable. That's really the only thing additionally you have to do. And before we use these books that used to be in the chapter in our old books when we had Cengage Learning, this particular book, Pearson doesn't choose to include it in the chapter, which is fine, but it isn't that much more difficult at all. But when you see it, if you take intermediate, you will definitely see trade-ins. And you can even check it out in the appendix, a couple of the examples. They give you a couple of examples. If we were in class, I would show that to you when we were all done testing on chapters 6 and 10. And probably before I move on at the beginning of our next chapter, which is going to be 13, I might show you a little example of it, just so you'll see it. And it's really, I think, kind of silly that they didn't put it in the chapter, but kind of good. Not another, another thing. It would be just another thing to learn in chapter 10. So we have enough things here. So anyway, we have the usage of the asset and then the disposal of the asset. They're very big on that word. They call it disposition or disposal of the asset, whether they discard it, whether they sell it, or even when they trade it in. For some reason, they use that word disposed of all the time. So once the asset is physically gone, it also has to disappear from your books, from your accounts, which means when that happens, we're going to credit the asset and debit its related accumulated depreciation account. But we're going to be doing that throughout in the later part, a little bit of the chapter. We're going to see that, and it's also in my third video. So that's kind of the first section. In the second section, which is on page 540, my light's kind of going here. I can't believe how dark it gets so early. It kind of explains, and I think in a very kind of concise way, what kind of costs you can add to your asset when you purchase it. We call this capitalization. The word capitalization is just a fancy word that means these are additional costs that you can add in and record your asset at the purchase price plus any costs that you incurred in order to make it usable, ready to use. So they give you some examples on page 540, purchase price, commission, survey, this is for land, survey and land fees, delinquent property taxes, any assessments to transfer the ownership or title, cost of clearing or removing an existing building, anything you would need to do to make that land ready for you, the new owner, to use. You can what we call capitalize it or add it to the asset. It shows you at the bottom of 540, and if you're looking at slides, I would be looking at slides 10, 12 to 10, 14. They have a purchase price of land of $50,000, and then they had to pay taxes, transfer fees, removal of the building that existed, and survey fees. That added another $12,000 to the cost of the land. So you can actually record, and if you look at the journal entry at the top of 541, you can actually record the land now not at $50,000 but at $62,000 because of those additional costs. And you'll be seeing that a lot. It's called capitalization. And then they took a note for $50,000 and they paid those improvements. We call them capital expenses. But you paid it in cash, and you got to add it to the cost of the land. Of course, with land, you don't get to depreciate that. But if you do, there are some things called land improvements that you do get to depreciate, such as, here we go. They also paid $20,000 for fences, paving, lighting, and signs. These things will wear out, so they can be depreciated. The land can't, but there's a separate account we can make called land improvements, and that can be depreciated. So you'll see that on page 541. Okay, and I'm up to slide, that was 1014 to 1016 if you're looking at your slides. Okay, when we move over to 542, they also talk about furniture and fixtures. You can do the same thing when you purchase them, buildings, machinery and equipment, any costs that happen, maybe shipping costs, installation costs, anything you need to make that thing work for you, to make it what we call usable, can be capitalized. The other thing I wanted to mention in this section, because it does come up in our video, I believe it's video 3, and there's also, I believe, a homework problem that has you do one of these. It's called a lump sum purchase. It's very, very easy to do, but you just have to do a little bit. I call it prorating. That means you apply a percentage, and I'll tell you what I mean. I'm looking at 542 now, and the slides are 10, 18, 19, 10, 18 it starts with. Actually 17, I lied. The lump sum purchase, they talk about this, and it's in red, the relative market value method. I've actually never heard it called that, except in this book. It just means when you make a lump sum purchase, sometimes it's called a bargain purchase. If you buy, just like anything else, if you buy things in bulk, you usually get a better deal. And that is the case with plant assets. So when you buy more than one, which of course would be two or more, you have to have an appraisal of those assets. If there's not one readily available at the sale, they'll always give you that if you have a problem like that. What is the appraised value or fair market value of the assets you purchased compared to what you bought it for? What we're going to do here is we're going to take, and if you look at kind of towards the bottom part of 542, it says that Smart Touch paid $100,000 for land and a building, okay? And the fair market value of the land is $30,000. Fair market value of the building is $90,000. So that means it's really worth $120,000. So that's the total fair market value. What you do is you're going to make percentages. You take the amount of the land, the $30,000, that's the fair market value, and divide it by the total fair market value, 120. 30 divided by 120, you get 25%. So 25% of what you paid, which is the $100,000, will go to the land. That means the land will be recorded by you at $25,000, 25% of the whole pie. And of course, by process of elimination, we know 75% will go to the building. However, it works in the division too. 90,000 fair market value divided by total fair market value of 120,000 is 75%. So that would be $75,000 because 75% of $100,000. So you would, when making your journal entry to acquire the land, you would debit the land for, what did I say, 25,000, 25% of 100,000. In other words, the same percentages as you got for the fair market value, apply it to your cost, and then 75% for the building. So there's the total you paid, 100,000 credit cash. That journal entry is actually on the top of 543. You'll see it. And I always called it, as a student, prorating, and that's what I was taught to call it. This book calls it relative market value method. Go figure. Anyway, there's different terms in different books, but that's how you do it, and it's pretty easy. The last thing in this section is capital versus revenue called expenditures, just means expenses. If you have expenses that extend the life, improve the asset so much it's going to extend the life of it, or the efficiency of it, such as a new engine in a truck, or a new transmission, right? This is going to improve the efficiency and or the life of it. So you get to capitalize that cost or add it to the asset. However, if you just have routine expenses like oil changes, things like that, brakes, right? Normal wear and tear, like think of your own car, right? Those are just routine, so that would be repair or maintenance expense. And those are called revenue expenditures. So they give you a little summary on page 544. What should be capitalized or added to the asset. You could debit the asset account for these costs, and when you would need to just debit an expense account, such as repair of engine, repair of transmission, replacement of tires, oil change, lubrication, things like that. Routine. Okay, so the next, that's it for that section. Again, the summary is on 544. What slide is that? Slide 1024, I believe. Let me just make sure I'm right about that. I haven't been flipping my things very well. Yes, 1024 is correct. Okay, the next section, the depreciation section, I'm not going to spend a lot of time going through it step by step because video 2 I do that for that sample problem. It's problem 37B. It's an actual problem in the back of the book, not the one you're assigned, but a very similar one. But depreciation is from page 545 to 552. And we're going now into slides 1026. There's quite a few of them, all the way up to 1038. So it takes a few pages to explain this because there are 3 methods. Again, there's straight line, which we already had, okay? And they give you the formula again. Cost minus residual life is residual value, which that means what it's going to be worth, the salvage value at the end of the depreciation. That's the numerator. Useful life in years is the denominator. Again, it's the most popular, easiest form of depreciation. And we did do an example all the way back in chapter 3. It gives you a depreciation schedule, and I believe it's a truck that they purchased for, let's see what they paid for the truck. Cost of the truck was $41,000, residual is $1,000, useful life in years is 5 years. So you can go through those pages for straight line, which are the first 2 pages, 546 and 547. Again, this is just, it's not a costing system. It attempts to allocate or spread the cost that you paid for your assets over their useful life. That's what depreciation does. It's kind of a made-up expense. It doesn't cause any cash to be paid out. Okay, so the straight line method goes up to slide 31. And then in slide 32, you have the second depreciation method, which is called units of production. It's very much like straight line. The numerator is the same, cost minus residual value. And the numerator is useful life, but not in years, it's in units. So you get the depreciation per unit first, and then you multiply it by the number of units. It's a very precise, exact depreciation. It's great for vehicles because miles. You can measure it by miles. It's great for a machine that runs and puts out units or runs by the hour because you can measure it. Usage like electricity or gas or water can use some of the years. Well, no, it's actually called now, not that long name. I almost said it, I'm going way back. It used to be called something else. It's called units of production. So again, it's similar to straight line except for the denominator is not in years, it's in units. And you have that second step of multiplying it by the number of units. And we're going to see in this case it's miles. Okay? And they do give you the number of miles expected that the truck's going to be driven. I'm really losing my light here. It's 100,000 miles is expected in the 5 years. So we would use that as the denominator, the 100,000, to get per unit depreciation. And it comes out to, how much per unit? It's 40 cents per mile is the unit. And then it's multiplied by the number of miles expected the truck to be driven. And I do 3 of these schedules out in the next video. And I explain it as I go. So if you think, gee, she's going too fast, don't worry, because I do it in every step by step. And it even kind of fits on the board, you'll see. Have a little bit of trouble with the first one, but I tweaked it. So I actually already did that video. So the last form of depreciation, units of production, ends at slide 34, I believe. Yep. gives you the schedule. And now I am on double declining, 548, and I'm on slide number 35. And that's the final one, and that's an accelerated method of depreciation. When I say accelerated, it means the depreciation is going to be much higher in the earlier years and much lower in the later years, because the formula is twice the straight line rate. So say the straight line rate in our case is 1/5, 5 years. So that's a 20% rate, or you can call it 1/5 times 2 or 2/5. I learned it by percentages. This book does not talk percentages. So you can just keep it as the fraction like they have it. But we would be doubling up on the depreciation, and the double decline is the depreciation declines as well as the book value declines twice as fast. And you will see that step by step when I do it in the next video. It's also very good in the book on page 548 through 549. They have a schedule 2 times 1/5 years for every year. You do ignore residual value in that there's the formula for it is, where's my formula? Cost minus accumulated depreciation, that's after the initial year, times 2 times the straight line rate. Okay? And so ignores residual value, but you'll see when we do the schedules in the next video, you only ever depreciate down to that residual value. You'll never go below it. Okay? In this case, you won't go below the $1,000. Okay. So that double declining example goes up to 1037, 1038. You'll see a really nice comparison, like a summary sheet of the 3 depreciation methods. It's very, very nice. It's on page 549. And it also has a vertical bar graph showing how they come out, each one. And of course, straight line is grafted using a straight line. That's where it gets its name. And that's on page 550. The annual depreciation method and how it looks on a bar graph. Okay. So there's partial year depreciation. If you purchased, say, an asset, the example here is July. If you purchase the asset in May, in June, in July, whenever, you count the months. In this case, it's July 1st they purchased something, so they could only take 6 months of depreciation, not the whole year. So it shows you they have the 41 minus 1, 40,000 divided by the 5 years. We know that's 8,000 a year for straight line, but times 6/12 because they were only using it, they only bought it July 1st. You'll see a lot of instances where you have to break up the year of depreciation by months. And again, a lot of that is in my video 3. When we have to bring depreciation up to date when we sell something, it's by the month. They tell us about how to count it. It's called a monthly convention, if you will. If you bought it from the 1st to the 15th, count it. But if you bought it from the 16th to the end of the month, either the 30th or the 31st, you can't count it. You need to have it 15th or sooner. That's how you count it. Okay, so let's see if I want to tell you anything else. That half-year depreciation is 4,000. So how do we report PP&E? It's on page 553. It shows you on the left-hand side, and that should be, I've got to catch up with myself. Not here. That's weird. Okay, I'm missing it somehow. But anyway, don't know if it had a slide. I don't see one. But what I just want to show you real quickly, before we go to the disposal of the assets, is there's a couple of ways you can report it on the balance sheet. It's the way they always show us with each one, and it's less accumulated depreciation, whatever that is, and the book values next to it. And again, that's at the top of 553. That's perfectly okay. That's a great way to do it. But you could also, there's another treatment. You can do a total of all of your plant assets just on one line, and then make a little asterisk, note C page in the notes, because financial statements always have notes to explain things further, and it will give you all the individual information. Many large companies do it that way. Okay, so the next kind of big area is the ending part of the chapter, the disposal. And again, I'm going to go through this part kind of quickly because my third video is all about this. Okay, that was partial year. Again, you might, what I kind of skipped out on a little bit before see, this is reporting was there. I skipped a whole bunch of them. The reporting one that I just did on 553 is slide 48. Sorry. The part that I skipped is if, for some reason, when you're doing a depreciation schedule and it's moseying on along very nice, something happens and either your useful life changes or your residual value changes for your asset, or both. It might devalue, it might increase in value because maybe you did some kind of wonderful improvement. If this happens, you don't have to change anything you did in the past, but you have to stop, get the new book value, and make a new straight line schedule. They only show it with straight line, and I kind of went right by that part. And just quickly, it's it's a small section, 551 and 552. This one changed its useful life. It's a truck, and it had been depreciating a couple of years. What to remember when you just make a new schedule, you have to use the book value at the time of the change. Okay? And then you just have a new depreciation moving forward. Don't know how I got by that before, but I did. Okay, so now we're on the getting rid of them part, which again is the second big topic I consider in the chapter. So disposal. How are disposals recorded? How do you handle it? Well, there's three ways to get rid of an asset. I was going to say fixed asset because my whole life I've been calling them that. Again, this book calls them property, plant, and equipment. So that's fine. So you can, again, discard them, donate them, bring them to the junkyard, whatever. They don't work, and you can't sell it, you can't get anything for it, okay? That can't, of course, give you any gain because you're not getting any money, but you can take a loss on it if it's not fully depreciated. You'll have a loss. Okay, and this discarding starts on 554 and keeps going, just 554 and 555. It shows discarding fully depreciated and discarding not fully depreciated. So they always call it disposal. I think in the second one it was only depreciated at 8,500, and the equipment the cost was 10,000. So you minus that and you get 1,500 for a loss. And I know I'm doing this quickly, but I go through it step by step in the last video. It's got all of those. There's no discarding, but they're selling. But discarding, again, you can have a loss, you can never have a gain because you're not getting any money. You can sell it, which is mostly what we do here, and that will produce either a gain or a loss, unless you sell it for book value, and then it's a wash, no gain, no loss. It shows you one that sells at book value, one that sells for more than book value where you have a gain, one that sells for less than book value where you have a loss. One thing to remember, just like always, and I mention this, I'm going to mention this a lot, we're going to have another chapter with gains or losses when we sell bonds, not for a couple more chapters, but gains are always credited and losses are always debited. Always, for any situation at any time. If you remember that, you'll be perfect. Okay? Credit gains, debit losses. Okay, so the selling part is 556 to 558. Gives you, again, selling book value, higher and lower. So you see the opportunity for gains and losses. They explain it very, very well. Again, I'm not going to go through it too meticulously because I do take that time in video 3. And it goes from 1057, as you can see, this chapter goes on and on. The summary is on 1064, and there's also summary journal entries on 10-65, 1064 and 1065 would be good to check out. I'll give you the page numbers. 559 and 560. Okay? So we're getting there. We've been through the 2 biggies. Okay, so those were our summaries. Okay, the latter part of the chapter has just got a couple more goodies thrown in because there's more to say, I guess they feel, about plant assets, and there's a little bit more to say. The first one is about natural resources. We say land doesn't depreciate, but certain industries deplete the land. When we say deplete, we mean take away from the value. So the word depletion almost is synonymous, if I could say that right, synonymous with depreciation. It does the same thing. It's showing the land being used up. Okay? And because it's getting used up, the value of its resource, timber or oil reserves or precious metals, right? Like iron ore or even diamonds. All of that gets depleted as someone buys the land and starts taking from it. How do we account for this? We use units of production. It's perfect. You get the depletion per unit by the cost minus residual value. There's not usually any residual value, so usually you don't have to deal with that. Over the estimated total units. They give you a number that's estimated you can derive from whatever it is. In this case, it's oil. So they give you number of barrels that can be taken. How do they know that? Statistically, that's what it is. They go by statistics. And then you get depletion per unit multiplied by how many barrels you actually took, if it's oil. Pounds, if it's ore or something like that. But you use units of production. You call it depletion expense instead of depreciation expense. And believe it or not, you also call it accumulated depletion of the land. Okay? You don't credit the land. So, that's that on page 564. In slides, where am I? Slide 67, 67 through 70. Talks about the example, it's oil, it's $10 per barrel is the unit. Okay, and you see the journal entry for the oil reserve, depletion expense, and accumulated depletion, and how it appears on the balance sheet. The last section, I promise, is the intangibles. Intangibles means you can't touch it, you can't feel it, you can't look at it, it doesn't have physical presence. This would be like a patent for something that you get from the government that nobody can copy, or copyrights like for music and movies and written word. Trademarks like the Golden Arches or DD for Dunkin' Donuts, right? Or goodwill, which is the reputation of the company. Only the ones we can measure, and we call this amateurization, another word that's like depreciation and depletion. They all kind of mean the same thing. We're spreading the cost of whatever we purchase over its useful life. We can only do that with patents and copyrights because they can be measured in years. They have a useful life. As far as trademarks and goodwill, they can be written down if they get damaged, if the reputation gets damaged, and hopefully it will increase over time. Okay, but goodwill is actually measured, and I wanted to, oh, by the way, you use straight line for amortization of patents and goodwill. I'm sorry, not goodwill, copyrights. I'm looking now at page 464 and 465. Actually, it starts on 562 to 565. The whole thing. So they do show you the amortization of patents. You could also do copyrights. Their favorite one is patents. They even say they have accumulated amortization if you wanted to use that. I've never seen that used in the real world. You may credit the patent, okay, or the copyright. In the case of goodwill, I just wanted to bring you your attention to page 564 because there's a problem here that's very much like a homework problem. When you see it, you can refer to this page. It talks about a company that purchased another company, and the sum of the market value was $9 million, right, of the assets, and the liabilities were $1 million, okay? And the market value, or the appraised value on the market, was $9 million, and the assets were $8 million. Suppose this company decided to pay $10 million to purchase Mocha. So they paid $1 million over, the net value of the company, assets minus liabilities, because of the good reputation. How would you account for that? And I'm kind of singling this out because I know there's a homework problem like this in your assignment. So the purchase price that they had to pay was $10 million, and this often happens. It will go above what we call net assets, which are assets minus liabilities. The actual worth on paper of the company is sometimes different, oftentimes different, than what it can go for on the market. Kind of like a house is the same thing. Goes for over the book value, if you will. So the market value of the assets, $9 million. Market value of the liabilities, $1 million. So the market value of, they call it net assets, which is assets minus liabilities, is $8 million. Goodwill is 10 minus 2 or, 10 minus 8 or $2 million. And again, I'm singling it out because it's almost identical to the homework problem you have. Okay, so if, again, you're looking at your slides, I already gave you the page numbers. We go right up to, the goodwill is 82 and 83. And again, on page 564, and it's over on 84. So you can see this chapter, unfortunately, was wicked long. Okay, the last thing is the ratio problem. It's very easy. It's about coals, like all of our ratio problems are, and it is the last thing. It's the turnover ratio. It measures the amount of sales generated from every dollar you invested in your asset. It tells you what you got in sales. For every dollar you spend on assets, what do you make in sales? Okay, of course you want it more than $1 to show that you're making a profit on your assets. And that's at the end, page 566, and a little bit on 567. And the appendix I was talking about, start right after that if you want to check out when you buy it, when you trade it in for a new one. I'll see if I can mention that when chapter 6 and 10 are all completely done and been tested on, just briefly. Thanks for your attention. That's all I have for right now. That's enough, right? And I'll talk to you guys soon. Any questions, just ask. Bye-bye.